In this session, we'll finish up our discussion of Chapter 13, which deals with financial statement analysis. So the debt ratio and the times interest earned ratio can measure a company's ability to pay debt. The debt ratio tells us the proportion of fixed assets financed with debt. A debt ratio of 1 reveals that debt has financed all the assets. A debt ratio of 0.5 means that debt finances half the assets. Generally, the higher the debt ratio, the greater the pressure to pay interest and principal. The lower the debt ratio, the lower the risk to shareholders. Analysts use the second ratio, the times interest earned ratio, to relate income to interest expense. To compute the times interest earned ratio, divide income from operations, or what we call operating income, by interest expense. This ratio measures the number of times operating income can cover interest expense and is also called the interest coverage ratio. A high ratio indicates ease in paying interest. A low value suggests difficulty. The fundamental goal of business is to earn profit, and so the ratios that measure profitability are reported widely, and we see these in this slide. So gross margin is net sales minus cost of goods sold. That is, gross margin is the amount of profit that the entity makes from merely selling a product before other operating costs are subtracted. Operating income, or profit percentage, is net income from operations as a percentage of net sales. Is an important statistic because it measures the percentage of profit earned from each sales dollar in a company's core business operations. The first component of high operating earnings is a high gross margin percentage. After that, maximizing operating income depends on keeping operating costs as low as possible, given the level of desired product quality and customer service. The ultimate goal of DuPont analysis is to explain the rate of return on common stockholders' equity in a detailed fashion by breaking it down into its component elements: rate of return on sales, asset turnover, and leverage. The first two components of the model combine to give rate of return on total assets. When the last component, or leverage, is combined into the model, it produces rate of return on common stockholders' equity. And you may recall we discussed DuPont analysis in an earlier chapter. But it is a widely used financial analysis tool that helps investors understand certain operating characteristics of the statement and the company under consideration. In business, return refers to profitability. Consider the rate of return on net sales, or simply return on sales. This ratio shows the percentage of each sales dollar earned as net income. Companies strive for a high rate of return on sales. The higher the percentage, the more profit is being generated by sales dollars. Again, we use this in a comparative nature, comparing it against prior year's rate of return, against competitors similar size in the same industry rate of return, or against industry published measures or standards rate of return. The asset turnover measures the amount of net sales generated for each dollar invested in sales. As such, it is a measure of how efficiently management is operating the company. Companies with high asset turnover tend to be more productive than companies with low asset turnovers. Having computed the driver ratios, that is the rate of return on net sales and asset turnover, we are now prepared to combine them into the first two elements of DuPont analysis to compute rate of return on assets. The final element of DuPont analysis, that is the last component of the DuPont analysis, is leverage, which measures the impact of debt financing on profitability. It can be advantageous to use borrowed capital to finance a business. Earlier, we expressed the debt ratio as the ratio of total liabilities to total assets. The leverage ratio, or equity multiplier, measures the proportion of each dollar of assets financed with stockholders' equity. Since total assets minus stockholders' equity equals total liabilities, the leverage ratio is just a way of inversely expressing the debt ratio. It merely looks at financing from the other side of the fundamental accounting equation. A popular measure of profitability is rate of return on common stockholders' equity, often shortened to return on equity. This ratio shows the relationship between net income and common stockholders' investment in the company. How much income is earned for every dollar invested? To compute this ratio, first subtract preferred dividends from net income to measure income available to the common stockholders. Then divide income available to common by average common equity during the year. Common equity is total equity minus preferred equity. And so earnings per share of common stock, or simply EPS, is the amount of net income earned for each share of outstanding common stock. EPS is the most widely quoted of all financial statistics. It's the only ratio that appears on the income statement. Again, EPS is the only ratio that appears on the income statement. Earnings per share is computed by dividing net income available to common stockholders by the average number of common shares outstanding during the year. Preferred dividends are subtracted from net income because the preferred stockholders have a prior claim to their dividends. So investors buy stock to earn a return on their investment, obviously. This return consists of two parts: gain or loss from selling the stock and dividends. Three ratios indicated here can help analyze their investment. That is the price-earnings ratio, the dividend yield, and the book value per share of common stock. And so the price-earnings ratio is the ratio of common stock price to earnings per share. This ratio, abbreviated PE, appears in the Wall Street Journal stock listings and online. It shows the market price of $1 of earnings. The PE ratio shows how much above earnings that a share of stock is currently selling. And oftentimes, the PE ratio is a measure of investors' confidence in the ongoing ability of a company to generate the same level of return and income. The dividend yield is the ratio of dividends per share of common stock to the stock's market price. This ratio measures the percentage of a stock's market value returned annually to the stockholders as dividends. Preferred stockholders pay special attention to this ratio because they invest primarily to receive dividends. And so book value per share of common stock is simply common stockholders' equity divided by the number of shares of common stock outstanding. Common equity equals total equity less preferred equity. Book value per share indicates the recorded accounting amount for each share of common stock outstanding. Many experts believe book value is not useful for investment analysis because it bears no relationship to market value and provides little information beyond what's recorded on the balance sheet. However, some investors base their investment decisions on book value. For example, some investors rank stock by the ratio of market price per share to book value per share. The lower the ratio, the more attractive the stock. These investors are called value investors, as contrasted with growth investors who focus more on trends in net income. And so our final objective here is to talk about other measures to make investment decisions. The top managers of some leading companies use economic value added, or EVA, to evaluate operating performance. EVA combines accounting and finance to measure whether operations have increased stockholder wealth. All amounts for the EVA computation except the cost of capital come from the financial statements. A positive EVA amount suggests an increase in stockholders' wealth, and so the company's stock should remain attractive to investors. If EVA is negative, stockholders will probably be unhappy with the company and sell the stock, resulting in a decrease in the stock's price. Different companies tailor the EVA calculation to meet their own needs. All amounts for the EVA computation except the cost of capital come from the financial statements. The weighted average cost of capital is a weighted average of the returns demanded by the company's stockholders and lenders. Cost of capital varies with the company's level of risk. For example, stockholders would demand a higher return from a startup company than from an established company because the new company is untested and therefore riskier. Lenders would also charge the new company a higher interest rate because it's greater risk. The idea behind EBA is that the returns to the company's stockholders, that is net income, and to its creditors, that is interest expense, should exceed the company's capital charge. The capital charge is the amount that stockholders and lenders charge a company for the use of their money. So now let's talk about some red flags in financial statement analysis. Recent accounting scandals have heightened the importance of these red flags. And so the following conditions could mean a company is very risky. So earnings problems. Some questions we would ask is, have income from continuing operations and net income decreased for several years in a row? Has income turned into a loss? This may be okay for a company in a cyclical industry, such as airline or a home builder, but some companies, they may be unable to survive consecutive loss years. Do we see a decreased cash flow? Cash flow essentially validates earnings. So is cash flow from operations consistently lower than net income? Are the sales of plant assets a major source of cash? If so, the company may be facing a cash shortage. We also would look at perhaps too much debt. How does the company's debt ratio compare to that of major competitors and to the industry average? If the debt ratio is much higher than average, the company may be unable to pay debts during tough times. How about the inability to collect receivables? Are days sales and receivables growing faster than for other companies in the industry? A cash shortage may be looming. The buildup of inventories would also be something to look at. Is inventory turnover slowing down? If so, the company may be unable to move products, or it may be overstating inventory as reported on the balance sheet. It could also be that this inability to move inventory results in the accumulation of obsolete inventory, which would have to be written off. Recall from the cost of goods sold model that one of the easiest ways to overstate net income is to overstate ending inventory. And finally, we would look at trends of sales, inventory, and receivables, since they generally move together. Increased sales lead to higher receivables and require more inventory to meet. And lastly then, an efficient capital market is one in which market prices fully reflect all information available to the public. Because stock prices reflect all publicly accessible data, it can be argued that the stock market is efficient. Market efficiency has implications for management action and for investment decisions. It means that managers cannot fool the market with accounting gimmicks. If the information is available, the market as a whole can set a fair price for the company's stock. In an efficient market, the search for underpriced stocks is fruitless unless the investor has relevant private information. But it's unlawful as well as unethical to invest on the basis of inside information. An appropriate strategy seeks to manage risk, diversify investments, and minimize transaction costs. Financial analysis helps mainly to identify the risk of various stocks and then to manage the risk. And so this completes Chapter 13 and the final chapter of our text. As usual, I encourage you to go back and make sure that you've read through the readings. These presentations obviously aren't intended to substitute for the readings, and then move into completing the learning exercises on Chapter 13. Also, I remind you that there's a final exam which you should also have a due date on in your course syllabus or in Moodle. I appreciate the opportunity to have gone through these chapters with you, and I hope you enjoyed the course. Thanks very much, and good luck in your future accounting endeavors.